Thank you all for dialing in. We have a high volume of people who have registered, and we will allow a moment for people to come into the room. Due to the large number of guests, we will not be taking questions from the audience. I would ask that you direct all questions after the call to your CBA contact. Alternatively, you can access more resources about the content discussed in today's call by visiting commbank.com.au/federal budget. I will now hand over the call to Chris Mclachlan, Executive General Manager, Global Markets at CBA. Please go ahead.
Good morning, everyone, and thank you for joining us for this special federal budget edition of our Economic Update series. Of course, last night we saw that Treasurer Jim Chalmers unveiled the federal budget and detailed the government's fiscal and economic strategy for the financial year ahead, and it also follows the Reserve Bank's latest announcement last week that saw the cash rate hold steady at 4.35%. To help us break down the budget highlights, probably one of the more interesting budgets we've seen for a while, the key policy announcements and what all this means for the Reserve Bank, I'm delighted to welcome two members from the CBA research team. We've got Chief Economist Stephen Halmarick and Director of Australian Economics Belinda Allen. Stephen, welcome. A busy night of analysis for the team, no doubt, although things are generally pre-announced these days, but lots of devil in the detail. So no doubt you've had a busy night interpreting the budget. I'll hand over to you to perhaps outline what you've seen, make a few comments. I really enjoy, I have to say, your publication overnight, which is on the edge of a narrow path. I think that really describes the scenario really well, and your job this morning is to help us work out if that path is in the Botanical Gardens or if it's on the cliff edge. So over to you, Stephen, just a bit of a view on how you're seeing it.
Well, thanks for that, Chris, and yes, good morning, and good morning, everybody. Great to be on this call. So I'm going to start with the good news in the budget. So the first bit of good news is for the financial year 2024, we're going to be in budget surplus by $9.3 billion. So that'll be the second year in a row of budget surplus. That's a very good outcome, very different to most other major economies around the world where large budget deficits have been seen for the last couple of years. And the other good news is the government announced a number of measures that will directly lower the rate of inflation. So from an estimated 3.5% as at June this year, June 2024, the inflation rate's forecast at 2.75% in June 2025. And that mechanical reduction comes from the electricity rebates and some rental assistance. So that's good news. Now I'll go into the not so good news, and that is that the budget surpluses disappear very quickly. And so we're going to be back in budget deficit for financial year 25 to the tune of $28 billion. That's 1% of GDP. And all of that deterioration since the mid-year budget, mid-year statement in December is from government policies. So they're spending an extra $9.5 billion next year. And then in 2026 financial year, the deficit jumps to almost $43 billion, 1.5% of GDP. And again, the vast majority of that deterioration comes from policy decisions. So that's a bigger easing of fiscal policy than we thought we were going to get. And I think you've seen from the general reaction in the media, a bigger easing of fiscal policy than just about anybody thought we were going to get. So that's going to be adding more money into the economy over the medium term than we think is ideal given the rate of inflation and the high investment required for infrastructure and the energy transition. So I'll leave the overview comments there, Chris, and we'll get into the questions.
Yeah, I think that's there's some interesting line items in here, and I'd say that forward picture looks a little harder to interpret than normally seen. So perhaps let's start with the future made in Australia. What do you make of that initiative, and maybe break that one down for us?
Yeah, so I think one of the cornerstones of the budget is definitely this future made in Australia strategy. Along with the cost of living relief, so as the income tax cuts and the electricity rebates, etc., The Future Made in Australia really is a strategy that tries to bring together government incentives for investment, particularly around the transition, the energy transition to get us to net zero carbon by 2050. They also talk about needing to have a more resilient and secure economy. And the government's been pretty clear about this. This is a trend you're seeing in most other countries around the world, particularly the US with their Inflation Reduction Act, of direct government intervention or direct government support to get investment into the areas of the economy where, they're really needed in terms of the energy transition and net zero. So they've estimated the cost of that program will be around $22 billion, but that's over 10 years. So it's not a huge amount of money, and a lot of it is government incentives rather than direct, tax incentives rather than direct payments. But there's things like what they call a front door for priority investment. So if you're a global investor known to the Australian government, you've invested here before, you've got a smart idea, your process of getting that investment improved should be accelerated. Things like renewable hydrogen, green metals, low carbon fuels, battery and solar panel supply chains, critical minerals. You can see very much there where the focus is going to be.
I want to come back to your cost of living points earlier, but just perhaps before we do there, did NDIS, some of the bigger items, education, do you want to just comment on that?
Yeah. So NDIS, the constant focus there is to find ways of saving money on the NDIS. It's a very large program, as people would know. So the budget actually is forecasting savings in that program of about $14 billion over the next 4 years. So that will help, make that program more, stable and over the long run. So some savings there. On education, there was a focus on reducing the cost of HECS, or I think it's now called HELP, so student debt. They're changing the indexation of that to lower the cost, or to lower the increase last year and this year. There's a focus on other areas like housing, which is critical. So $6.2 billion in new initiatives to assist in building new homes. $1 billion going to the states to help them. Things like social housing, homeless services, build to rent. So a welcome and good focus on that need to just get more housing into the system.
Yeah, I think as you just alluded to there, a lot of the topic areas that they've clearly focused on all make sense from a strategic point of view. I guess the really big question is going back to your edge of the narrow path narrative is the impact on inflation. So let's just go back to the cost of living relief and understand the view, because on first read you get a mechanical reduction in the inflation rate this year. That can be maybe explain the relative impact of that, but that does push out, or the reflex response to that is you think that inflation over the longer term could be a problem. It's a really tricky path to navigate. So can you just, let's go back over your views on that, and perhaps we'll get to Belinda in a minute and we'll talk about the RDA, but I'm really interested in your views on this one.
Yeah, sure. So if you look at the cost of living relief, there's a few major things. The first is the income tax cut. So, very well known, very well flagged. Every taxpayer gets a tax cut from the 1st of July this year onwards. So that's not new, but what was new is a $300 electricity rebate for every household. Now, previously, that type of policy would have been means tested, so that people on higher incomes would not have received that. But this time around, and that's everybody gets it, every household, and that's worth $3.5 billion. Now, the way that works is it'll just lower the price of your bill. So whatever your electricity bill was going to be, it'll be $300 less. Now that mechanically, we think and the government thinks will lower the headline inflation rate by 0.5 percentage points for 24-25. So that means if the inflation rate had have been forecast at 3.25 in June next year, it's now forecast at 2.75. And so that's a big change. And of course, the really important thing about the 2.75 is that's within the Reserve Bank's target range of 2 to 3%. In addition, you've got increased support for low-income earners who are renting, and that's worth another $1.9 billion. And that itself will also shave about 0.1 percentage point off the headline inflation number. And then there's been recently some state government support in this area as well. So all up, over the next year or so, the inflation numbers could be lowered by as much as 0.75 percentage points. So that's quite large, right? Now, one of the key issues is that's the headline inflation number, which the Reserve Bank needs to target in the target range. But the so-called trimmed mean or underlying inflation rate probably won't see that big decline. So you'll have this gap between underlying inflation where these big changes from government policy are not really in the calculations, whereas the headline number will be down a lot further. And then the $64 million question, if I can put it that way, is what do people do with that extra money? They'll be paying lower income tax and they'll be paying lower amounts of money for electricity. So do they take that extra money and just go and spend it? And if it's spent somewhere else, that could put upward pressure on inflation elsewhere. But there has been some studies done that show that right now, if people have been asked if you get a windfall, what would you do with it? And a lot of people said they'd either save it or use it to reduce debt. Now, given the relatively high level of interest rates, reducing your debt is actually probably the most optimal thing to do with a windfall of money. So it's very difficult to kind of unpick what the if you like the net inflationary impact from all this will be, but it'll mechanically lower the headline inflation over the next year. But as I said at the overview, then we've got big budget deficits, not just next year and the year after, but beyond that. So that is putting more money into the economy, which could make it more difficult for the RBA to sustain inflation inside that target band.
Yeah, and I think that's the punchline here is that, you get the reprieve from the inflation mechanically this year, but we're taking more risk in future periods, which gives us a really delicate balance for the RBA to manage. So, and just before we go on to Belinda and talk RBA, we should just, Stephen, fundamental to any of these budgets is understanding the economic assumptions in there, in particular commodity prices. Just any comments on that?
Yeah, so the government's economic forecasts are a little bit more optimistic than ours. So they've got growth of 1.75% in this financial year and then up to 2% next year. So we're a little bit more modest than that, but not significantly so. Our unemployment rate forecasts are pretty much the same, 4.5% as at the middle of next year. But as you suggested there, these economic forecasts from the government are based yet again on very conservative commodity price forecasts. So a good example is iron ore, our biggest export. They are projecting the iron ore price to be back at $60 a tonne over the next year or so, whereas our own forecast is for iron ore to be closer to $92 a tonne by June next year and $110 a tonne June this year. So those, if we're right on the commodity forecast, and I have to say we usually are pretty good on those, that will support a bit of extra growth, which should help the budget bottom line over the next year or so.
Yeah, important consideration, and in that the windfalls there from a higher commodity price, can support the budget position. And just interestingly, while we've been on this call, the Australian Office for Financial Management have updated the borrowing forecast for the government for the year ahead, and it's probably lower than we initially thought on looking at the spending measures. And so So you take that and you take your comments on commodities. Perhaps there's a little bit of support for the structure of the budget there going forward. Why don't we pivot here and just look at implications for the Reserve Bank? Belinda, I'll bring you into the conversation now. RBA held rates steady at 4.35% last week, but clearly, a sort of a higher for longer narrative leading into that announcement. Given we've held the cash rate constant since November last year, now we've got this budget outcome. What do you think this means for the RBA?
Hi, Chris, and good morning to everyone on the line. Thank you for joining. So I think as Stephen kind of highlighted before and how you summarised, Chris, I think the budget kind of tells a twofold story for the Reserve Bank. So in the near term, measured inflation is lower. Reserve Bank will be happy about that because not only does it bring down measured inflation, but it also anchors inflation expectations and wage expectations as well. So you do have, I guess, a twofold impact from those rebates. But I think what the budget has also shown is there's more stimulus hitting the economy over the second half of this year than was expected. So we knew the stage 3 tax cuts were coming through. They're worth about $20 billion. We now have the household energy rebate worth around $3.5 billion as well. And as Stephen said, we don't know how much of that's going to be spent. Households are incentivised at the moment to save rather than spend because we are in a higher interest rate environment. But if that behaviour changes and if we do see more spending come through and less saved, then I think the risks around our November base case scenario for the start of the easing cycle is at risk. And we'll obviously look at particularly the consumer spending data over the second half of this year to see the reaction function. But I think more broadly, the larger deficits for longer, both from federal government and also what we're seeing from state governments as well, the very large investment pipeline we have in Australia does suggest that interest rates, could be staying higher for longer. We have the cash rate coming down by 125 basis points by the end of 2025. The cash rate at 3.1%, that's around the top end of where we expect neutral. Maybe neutral is a little bit higher as well if we're getting more stimulus in the economy. So a twofold impact for the RBA, kind of risks around the starting date depending on the consumer response and potentially, as you said, that higher for longer scenario. But the Reserve Bank will be looking at the budget, but I think at the moment they're also focused on, the second quarter inflation print, wages and labour market data that we get out this week as well.
So a busy week for data. So perhaps we come back in the summary so we can remind everyone what to watch for. So in our own data, Belinda, I mean, you talk about people's propensity to save. I mean, what are we watching there in terms of consumer patterns that people could expect to see from us that might help them keep a handle on this propensity that people might have to spend any windfall gain and therefore put pressure on consumption?
So one of the things that we've really highlighted, particularly in our own CommBank household spending insights data, we released it on Monday for April, is we are seeing consumers really wind back spending and even cut spending on discretionary items in particular. So things like hospitality, recreation are definitely weaker compared to a year ago. We're also seeing consumers cut back on like the essential food spending as well. So we know households are hurting and they're having to do that because they're having to spend more of their income on things like mortgage repayments and rent, but also on items like insurance, health, education and utilities where we have seen big price rises. So I think if we see that pattern of consumer behaviour switch, if we do start seeing maybe some more spending on discretionary items come 1 July, that is what we're watching. We also do get savings data as well, and we do know households have been saving more, particularly paying off their mortgage at a faster rate as well, just because of the incentives around high interest rates. We'll be looking at how those two pieces of data work together. Do we see more discretionary spending and are households getting a little bit less willing to save given household disposable income is rising?
Yeah, one to watch for sure. So as this plays out, I think you mentioned our rate forecast. I mean, just in terms of timing, should our listeners expect any revision in the forecast to Belinda and Stephen in terms of the outlook, given the sort of wave of news this week?
So, I mean, we did change our forecast after that first quarter inflation print. That was a little bit stronger than what we and the RBA had expected. And as inflation forecasts were revised a little bit higher towards the end of the year, obviously we now got more rebates coming through, and that will lower measured headline inflation. I guess this week, today, just in a bit over 2 hours' time, we do get the first quarter wage price index. We are expecting a 0.9% lift for the quarter and annual growth to be 4.2%. Tomorrow we do get labour market data. We know that's been incredibly volatile in recent months, with the unemployment rate currently sitting at 3.8%. We do expect that unemployment rate to keep moving up. So we're watching that very closely to see if we continue to get a deterioration in that labour market data. Beyond that, though, obviously we're looking at the inflation prints coming through. So near term, it's not suggesting we do need to make any changes. I think it's over the second half of this year, as I said earlier, that we really will have to watch how consumers respond to the budget and whether or not that suggests that we do see a different interest rate environment going forward. That's the household side, though. As Stephen mentioned earlier, there is a lot in the budget around the investment side. We're also seeing that from state governments. So the pressure in that part of the economy, CapEx spending, residential construction, business investment, all the spending on renewables, what that means for the inflation pipeline going forward will also be really important to watch.
Yeah, there's a wall of investment, including defence spending, which we haven't covered yet. There's the energy transition. There's the requirement to build more housing stock, and then there's cost of living pressure. So it all sort of is a fairly big wall. I mean, I'd just say the other thing on the interest rate outlook is, of course, financial markets will move swiftly to price any changes of expectations on forward rates. Many people on the call are borrowers, which would be interested in longer term rates. Obviously, we'll be watching very closely to see how financial markets interpret both the budget and subsequent borrowing requirements from, as you say, both federal and the state governments who've been out recently updating their borrowing programs and budgets as well. So, Stephen, you perhaps loop back to you just on that investment outlook. I think just sort of building on the picture there, we talked a lot about the consumer, but that sort of investment pipeline and perhaps how people should be thinking about that in terms of the inflation outlook.
Sure. As Belinda mentioned, the consumer side of the economy is quite weak, and we can see that very clearly in our internally generated data. But the investment side of the economy is actually been performing very well, and that's both private sector and public, so particularly state governments. So if we look at the forecasts in the budget, they are still expecting further improvements in business investment in the years to come, particularly the non-mining sector, and a lot of that's related to the energy transition. So this year, FY24, the non-mining investments are forecast to be up 5.5% after being up 10.5% the year before, and then increases of 2.5% next year and 2% the year after. So private sector investments quite solid, and the surveys on investment intentions continue to improve. And then, as we've been saying, on top of that, you've got state governments investment, particularly into the infrastructure space. And we can see that in a couple of the state budgets so far, and there's more state budgets to come in coming weeks. So whilst the consumer side of the economy is weak, and that's been dragging down some of the inflation pressures, and weak and getting weaker, I should say, the investment side of the economy looks still quite solid. And now the Commonwealth government, through an expansionary fiscal policy, is adding a bit more to that. All
right, so plenty there. So why don't we just given where we are with time, why don't we sort of wrap up with some summary, your final takeouts. I'll go to each of you. And one thing, perhaps, Stephen, that I should have asked, we earlier, we have chances of an election next year. So should people be expecting, a mini budget at some point along the line? What should people be expecting there?
Yes, so it's interesting. A few months ago, the Prime Minister kind of let slip in an interview that next year's budget's more likely to be in March, so a couple of months earlier than usual, and that would strongly suggest that around about this time next year, so May next year, would be going back to an election, which is when the election was. That'd be 3 years. So we should get another budget early next year ahead of the election. And they always have what they call, the mid-year economic and fiscal update, so the MAEFO, in December every year. So if we're right on the commodity prices, and actually the budget deficit for FY25 is looking a little bit less than expected, maybe that gives the government a little bit extra money to spend ahead of the election. And the other thing we haven't talked about, which I think is worth mentioning, is just what's happening with population growth and net migration. So, net migration surged dramatically in financial year 23. It was up 528,000 people. So that's more than double a normal pre-COVID year. Pre-COVID, we were averaging about 235,000 net migration. So the budget is forecasting a softening in the net migration numbers, so that for FY24 it's 395,000, then FY25 back down to 260,000. And there was measures in the budget to really, if you like, put pressure on the universities in particular to if you like, cap the number of foreign students they bring in relative to the amount of housing available. So universities have to be much more responsible for making sure that all the foreign students they bring in have somewhere to live. So I thought that was an interesting change, and that will be an important part of controlling the inflation outlook as well. But just, final comments from me, some good news in that 2 budget surpluses in a row is great outcome. Mechanically going to lower inflation in the near term. But over the medium term, we are going back to budget deficits that are larger than we thought they should be, larger than ideal. And that's going to put some, upward pressure on getting inflation, sustainably back into the target range. But good to see that future Made in Australia focus on the government really trying to ensure we get the right investment in the right places in terms of energy transition. So a lot there, and the research team, we put out a big note late last night. We've also got a podcast that people can listen to. So we'll just offer all that to all our clients. But I'm sure Belinda's got some final thoughts on the RBA.
Yep, Belinda.
Yeah, just following from what Stephen said, I think just focus on the near term for the Reserve Bank, which will be the consumer response to the rebates and the tax cuts through the second half of this year. And then longer term, as Stephen said, there's larger deficits for longer, a higher investment outlook for the Australian economy. So what that means for both the neutral cash rate and where the Reserve Bank lands over coming years does suggest there's some upside risk to that. And I'll leave it there. Thank you.
Yeah, well done to both of you for breaking that down for our listeners. I mean, I think really thinking through that short term, good story versus long term complexity. Of course, in the short term, we are seeing household weakness in our data, but a really strong investment pipeline. Long term, the strategy we understand from the government, all those topic areas make sense, but obviously some real complexity in terms of how that flows through, as you mentioned, team. And so all we can do is watch the data and, as you say, reports like you put out overnight, Stephen, with a great headline, Edge of a Narrow Path. I mean, I think it sort of paints a picture. And so if people want to access further budget highlights, you can contact your Commonwealth Bank contact, or you can visit the website. There's more resources on commbank.com.au/federal budget. But as the team have already mentioned, they'll be putting out plenty of publications in the near term. And it's a busy week of data. We've got more to come And obviously, as Belinda pointed out, watching that consumer spending behaviour on the back of a windfall game in form of tax cuts, energy and rent relief will be really important to watch for everyone. Thanks everyone for joining. Thanks Stephen. Thanks Belinda. Have a great day.
That does conclude our conference for today. Thank you for participating. You may now disconnect.